Welcome to Vought Daily Finance, the most important news personalized for you every day. Supported by Vought.com.
After listening to today's news, you'll know first record $52 trillion wealth for US top 1% tires, economy's fate to a volatile stock market, raising systemic risk. So we'll discuss why this massive wealth concentration creates a fragile asset economy and what it means for systemic risk and Fed policy. Second, Trump's Project 2025 weaponizes government shutdown to reshape agencies, threatening to spike bond yields and upend global energy markets. We'll examine how this aggressive fiscal strategy creates massive policy uncertainty and how it could drive up US Treasury yields and borrowing costs. Third, Detroit auto stock surges Trump mulls tariff immunity, potentially saving Ford and GM billions and reshaping the EV landscape. Today, we'll take a closer look at why Tesla's stock fell on the news and its implications for a potential investor rotation from EV growth to industrial value. The top 1% of Americans just saw their collective wealth hit a record $52 trillion. Fueled by a surging stock market, the wealthiest 10% now control a staggering $113 trillion in total. Since 2020 alone, that group has added over $40 trillion to their net worth. And this isn't just a domestic story. The US has increasingly become a global magnet for capital. Compared to perceived instability in other major economies, the US market, with its dominant tech sector, is seen as a safe haven. This means significant international capital, including from China and Europe, has been flowing into US assets, propping up the dollar and inflating these very asset valuations. For our audience in China, this has a direct implication. These capital inflows into the US can influence the exchange rate and affect investment decisions globally. And if you look at the absolute pinnacle, the top 0.1%, or those with a net worth of at least $46 million, their total wealth has nearly doubled since the pandemic, now standing at over $23 trillion. The engine behind this incredible surge is the stock market. The top 10% now own over 87% of all corporate equities and mutual fund shares. This massive concentration is creating what economists are calling a K-shaped economy, where a small group's fortunes rocket upward and their spending now props up the entire system. So the thing is, this dynamic is creating split-level inflation. The spending of the wealthy is driving up prices for things like luxury services, which saw a 5.5% increase. Meanwhile, prices for essentials like groceries, which affect everyone, rose by a much smaller 2.1%. This creates a confusing picture for policymakers like the Federal Reserve, because the overall inflation number might hide the fact that different parts of the economy are experiencing very different realities. New data reveals consumers in the top 10% now account for nearly half of all consumer spending in the country, the highest level since tracking began in 1989. So the obvious question is, what happens if the market turns? And that leads us to the central risk here. According to Mark Zandi at Moody's Analytics, the economy is now being powered by the spending of the extraordinarily well-to-do. He warns that if the richly valued stock market were to stumble, this group will quickly turn more cautious in their spending, posing a serious threat to the already fragile economy. It all comes down to a concept economists call the marginal propensity to consume. Basically, lower income families tend to spend any extra dollar they get, which boosts the economy from the ground up. The wealthy, by contrast, tend to save or invest it. But the situation has become so extreme that the entire economy now relies on the spending of this top group, whose spending is directly tied to their volatile stock portfolios. This creates a huge asymmetric risk. If the market falls, their spending could drop much more sharply than expected, derailing the whole economy. What's really fascinating is that some economists are now arguing this is more than a K-shaped recovery. They're calling it an asset economy. This is a system where national growth depends not on broad-based job and wage growth, but on the rising value of financial assets owned by a small minority. This makes the economy incredibly fragile and vulnerable to a single point of failure, a stock market downturn. It's a situation that draws chilling parallels to Japan's bubble economy in the 1980s, where traditional indicators looked fine right before the crash. Ultimately, the health of the broader economy is now profoundly linked to the stock portfolios of a tiny fraction of the population, and their fortunes are tied directly to a market that one leading analyst warns poses a threat to the entire system. From one form of systemic risk to another, While the market's fragility is tied to wealth concentration, a different kind of threat is brewing in Washington. The government shutdown isn't a political stalemate, it's a weapon. And Donald Trump just handed it to a man he calls the Grim Reaper. This is where the situation takes a more complex turn. In the past, shutdowns were mainly leverage for congressional deals. What's happening now is different. The current strategy appears to use a legal grey area to unilaterally reshape the executive branch itself, setting a new and dangerous precedent. At the heart of this is the Empowerment Control Act of 1974, a law meant to stop a president from refusing to spend money Congress has approved. By challenging this, the administration is testing the very foundation of congressional power of the purse, which could increase long-term US political risk. His name is Russell Vought, the architect of Project 2025, and he's now been empowered to use the shutdown to make deep, fast cuts to federal agencies. Trump, who once distanced himself from the 900-page plan, is now openly embracing it, calling the shutdown an unprecedented opportunity. Now get this, the weaponization of budgetary power creates massive economic policy uncertainty. There's an index for it which has been spiking. This kind of uncertainty is poison for private investment. When companies don't know the government's next move, they delay big projects and hiring. The Congressional Budget Office found the 2018 to 2019 shutdown, which was much less aggressive, still caused a permanent $3 billion loss to the economy. This time, the impact could be far greater. The actions are already underway. Vought has put major infrastructure projects in New York City and Chicago on hold. He has also cancelled nearly $8 billion in clean energy projects across 16 states. And this has major global implications, especially for China. The abrupt cancellation of US clean energy projects could create a sudden supply glut on the world market. To put this in perspective, Chinese manufacturers currently control over 80% of the entire global supply chain for solar panels. A sudden drop in US demand could push global prices down, strengthening the market position of Chinese companies while chilling investment in the very US and European domestic alternatives meant to compete. In effect, this move undermines Western energy security goals. The strategy is so aggressive, it's making some Republicans nervous. Senate Majority Leader John Thune warned this is the risk of shutting down the government and handing the keys to Russ Vought. Another Senator, Mike Lee, told Fox News that Vought had been preparing for this moment since puberty. And their nervousness isn't just political. You know, the bond market is watching very closely. If the administration is making these dramatic cuts, but is also expected to pursue other expensive policies like tax cuts, bond investors may see this as fiscally irresponsible. That perception could drive up long-term US Treasury yields. Put simply, higher yields mean higher borrowing costs for the entire economy, from mortgages to business loans, potentially counteracting any disinflationary effect from the spending cuts themselves. This isn't a new concern. S&P already downgraded the US credit rating in 2023, citing a deterioration in standards of governance. On fiscal matters, this isn't just about budget trimming. Vaught's team, which worked with Elon Musk's Department of Government Efficiency earlier this year, sees this as a moment of existential crisis. So where do we go from here? The most immediate indicator will be weekly initial jobless claims. We need to watch for regional spikes, especially in areas with a high concentration of federal workers. This could be the first sign of negative spillover effects. Beyond that, keep an eye on the 10-year Treasury yield to see how the bond market is pricing this new fiscal risk, as well as the stock performance of companies in the infrastructure and green energy sectors. As one Heritage Foundation director who knows Vought well stated, for Russ, for myself, for anybody who's in the budget space, this country is going bankrupt. Whatever the political risks of trying to do the right thing, we have to do it. If we do nothing, this country will implode. It's a collision between an ideological drive to shrink the state and the market's need for stability. The outcome will have significant consequences for interest rates, investment, and the US. Dollar's role in the global economy. Speaking of the economic ripple effects from potential policy shifts, another story today sent a jolt through the stock market. Detroit is roaring. Shares for General Motors, Ford, and Stellantis just surged in afternoon trading, with Ford hitting a new 52-week high of $12.67. The catalyst? A bombshell report that Donald Trump is considering what's being called significant tariff relief for vehicles produced in the United States. This isn't a minor tweak. it's a potential earthquake for the auto industry. But that's not the whole picture. The real turning point is how this policy functions on a global scale. Interestingly enough, such a policy which rewards domestic content effectively functions as a non-tariff barrier, particularly against Chinese automakers. The big takeaway is that it could force global car companies to run two separate, less efficient supply chains, one for China and another for Western markets. This is a huge deal because the US imports between $15 to $20 billion worth of auto parts from China every year. This policy isn't just about rewarding American assembly, it's a major move in a geo-economic chess match. According to Republican Senator Bernie Moreno, the message to global automakers is direct. In an interview, he stated, "The signal to the car companies around the world is, look, you have final assembly in the US, we're going to reward you." He then delivered the line that sent shockwaves through trading desks, adding that top domestic producers like Ford, GM, and Toyota will be immune to tariffs. To understand why the word immune matters so much, you have to look at the jaw-dropping costs. Ford previously said it expected $3 billion in US tariff-related costs this year alone. For General Motors, that figure was as high as $5 billion. Now, this presents a massive strategic choice for these companies. They could simply take these billions in tariff savings and book them as short-term profit. Or the promise of long-term relief could incentivize them to make huge investments to reshore their supply chains back to the US. It's a tough balancing act, especially with existing rules like the US-Mexico-Canada Agreement or USMCA, which already mandates that 75% of a vehicle's components must come from North America. The key focal point to watch will be whether these automakers announce new US factory investments or if the savings just flow to their bottom line. So the billion-dollar question is, if automakers save billions, will car prices actually go down for you? Well, it's complicated. Research from the Federal Reserve suggests that when companies get cost relief like this, the savings aren't always passed on. Instead, automakers might use this opportunity to increase their own profit margins. This decision brings both potential benefits for car companies and comes with inherent risks for inflation. It's a clear example of how a policy aimed at automakers can ripple through the entire economy and influence the Fed's decisions on interest rates. The market immediately priced in this possibility, sending shares of Ford up 3.7% and Stellantis up 3.2%. Now, here's where it gets interesting. In a fascinating twist, Tesla, another major US producer, saw its stock close down 1.4% on the news. On the surface, this seems counterintuitive. So what's actually happening here? It seems the market is signaling a major shift in sentiment. According to the American-made index, which ranks cars by their contribution to the US economy, Tesla's models are consistently at the very top. By comparison, legacy automakers like Ford and GM have much more complex, globalized supply chains. So, the market's reaction suggests investors believe this policy might actually benefit the old guard Detroit companies more, possibly because their vast international supply chains give them more to gain from tariff immunity. This could be interpreted as a potential rotation in investor preference, away from tech-focused EV growth and toward traditional industrial value within the auto sector. This developing story pits billions in current tariff costs against the promise of total immunity, creating a high-stakes showdown over the future of American auto manufacturing. This content is for informational purposes only and is not investment advice. All stock market information is subject to change.
That's it for today on Vought Daily Finance. Follow, share, and stay tuned for daily updates coming your way tomorrow.